I've owned my own business. Most years, it's what I've talked about for the last 30 years.
One day, like, I went to school, like, late from school, you know, like, I had to, like, listen to hours, like, people like that. Like, school day, have to go off home from school, and then I was like, I was part out, like, I was like, oh, yeah. Like, I had this section lesson. I know. I really tempted. I was going to home in the morning, I was like, yeah, I don't want to go to school. Not to school.
You guys.
Hi.
Alright, you guys, let's go. Let's get started here. Not bad. Alright. Okay. So, let's pick up where we left off. Let's get into warranty. Now, what happens with warranty? So what happens here is, don't forget, the reason you offer a warranty is because it increases sales. So if you look at, so a lot of times, you know, if something has a really good warranty, you're more likely to buy it, right? A warranty, however, to the company that issues it, it's an expense. Man, that was a good Centurion voice. I should practice that, yeah. Anyway, all right, sure, I'll remember that. Okay, anyway, so here's the deal. When they sell whatever they sell, that warranty comes with it, that's an expense. And that warranty increased the sale, right? So what it is a warranty is an expense. So it's an expense. And what governs this is the matching principle. Okay? So here's how it works. So in this case, what they do is they sell a car, and let me just explain, they sell a car for $16,000. Okay? Now a smart car costs more than $16,000. I wonder if they sold for $16,000. Okay. Oh, could be. Maybe. Oh, what?
Kia Rio.
Will that do it? Okay. All right. Because, yeah, I think even that Fiat 500, which is a really cool car, I think that's closer to 20. Anyway, and then they estimate that 4% of the cost of the car will be the, it's how much is a warranty expense.
But usually runs about $2,000.
Well, what it is what they say is, as a general rule, that 4% of the cost of the car is what this warranty will cost us. Now, this is an estimation, right? So, for instance, I had a neighbor, and what she did is she got a used car, got a muffler and Midas, I think it's one of those, and it had a lifetime guarantee. If this muffler ever wears out, as long as you own the car, we'll replace it. Now, the average person owns a car for 2 years, so they design their mufflers to last 2 years, right? But the guarantee doesn't go with the car. She kept this thing for 10 years, and every 2 years, she'd go in and get a new muffler, right? So, anyway, the point of the matter is they estimate. So in this case, what it is they have, so now we have 16, so they have 1,600, 16,000 times 4%. That means that it's $640. So when they sell the car, and let's say they sold it on December 1st, the warranty expense is $640, and estimated warranty liability is the account. For $640, okay? Now, on January 9th of the next year, somebody comes in for some warranty, And and what it is the $200 part, and all they're gonna do is do the parts in this. So now when they honor the warranty, so, I'll just put it up here and then we'll explain it. So the estimated warranty liability is $200, and auto parts warranty, auto parts inventory, $200. So here's what happens is, at the time of the sale, they declare the expense. It's because the warranty is part of making the sale, right? So since the warranty expense generates the sale, that's when they declare, that's when the time when they declare the warranty expense. And then it's an estimated warranty liability. So this is at the time of the sale. Then when they honor the warranty, then in this case, all they're worried about is the part. It could be, you know, labor, of course, would work in a very similar fashion. And in this case, it's a $200 part, so it comes out of the liability, it comes out of the inventory. So this is what it's like when they honor it, this is what it's like when they incur it. And this is at the time of the sale. Okay? So, you guys want to do exercise 1111, page 465. Now here's what it looks like, and it's for practice. So it's exercise 1111. Here it is. Okay, this looks like a pretty thorough exercise. Let me. Yeah, this is more than you're up for. You guys thought it'd be like a skate. All right.
Oh, we're doing bonus plan again.
What's that?
The bonus plan.
A bonus plan? All right, you're hoping like another bonus plan or something, huh? Okay, well, no luck. Let me put this up here. All right, and then I'll, let's see, today is Wednesday. I'll try to put this up probably Thursday afternoon is when I'll have time to put that in YouTube. Okay? So here's 1111. This is how it reads. So the chain company sold a copier costing $3,800. Oh, did I hit recording that?
Yeah, it's going.
Yep, it's going. Okay. All right, so the chain company sold a copier for $3,800 with a 2-year parts warranty to a customer on August 16th for $5,500 cash. Chang uses the perpetual inventory system. On November 22nd, the copier requires on-site repairs that are completed the same day. The repairs cost $199 for material taken from the repair parts inventory. These are the only repairs required for 2012 of this copier. Based on experience, Chang expects to incur warranty costs of 4% of the dollar sales. It records warranty expense with an adjustment at the end of the period. All right? So how much warranty expense does the company report for 2011? How much is the estimated warranty liability for this copier as of December 31st, 2011? How much warranty expense does the company report in 2012? How much is the estimated warranty liability for this copier at the end of December 31st, 2012? Prepare journal entries to record A, the copier's sale, B, the adjustment to recognize the warranty expense, and C, the repairs. And why don't you guys work in teams to kind of move through this thing quickly so we can get the lot done? Does that sound good? Maybe just choose somebody next to you or close by, and we can get the most done. Yeah.
Okay, so the 4% sale, not the cost, right?
So what it is it's, so the warranty expense is 4% of the sale. So what it is,
$5,500 was the selling price, $3,800 was the cost.
so 4% of this,
That would be,
okay,
That would be the cost.
the
Okay,
cost.
so it
Four-
is the sale.
So when they make the sale, now
Wouldn't it
don't
be
forget, when they
upfront?
make the sale, what will happen here is you'll you'll have this will be a retail, this will be a wholesale, right? So you'll debit cash and credit the sales for 5,500. You'll debit cost of goods sold and credit inventory for 3,800. And then at that time, you'll account, well, and this expense is not done as an adjustment in this case, but it'll be done in the period of the sale. Okay, here we did it at the exact same time, but doing it in the same period, we do the exact same thing. And the reason and the way they do it is it's a percentage of the value of the inventory. And Michael, this is kind of what you were talking about earlier.
Oh, it's just a meeting, weren't you?
Really?
So it's probably 4% times.
So it's gonna be like. Because
Is that?
Move that
Oh,
one.
sure.
Thank you.
All right, let me give you a hint. So here's the first one. The warranty expense, be 4% of dollar sales, 4% of 5,500. So the warranty expense in the period of the sale will be $220. And they do this as an adjusting entry. The example of the board, we just did it at the time of the sale. Both are the same. Match the expense to the revenue.
Thanks, you too. So everything's 220.
Used up 199.
All right, here's the next one. On December 31st of 2011, the balance of the liability equals the expense, but because no repairs were in 2011. Therefore, the ending balance and the estimated warranty liability would be 220, right? Then, in 2012, there's no additional expense. And then in 2012, here's the beginning balance in the warranty liability. Here's the cost of the parts. To honor the warranty, here's what's left. Yeah.
Now, it says the adjustment on December 31st to the warranty expense. I'm sorry, I'm on 5.
Oh. Hey guys, listen, let's go up to 5.
I thought that would be recognized all the
So
time.
here, let's kind of go through it. Now what they do is they ask you to journalize these things in effect. So, when they make the sale, again, because it's the perpetual system, don't forget, here's the retail, and so you debit cash, you credit sales, and then here you convert the asset into an expense. So you take it out of inventory and you put it in cost of goods sold. Cost of goods sold is an expense for a store, right? And so this, then, here's the adjustment for, here, back here when they figured the 220. So you debit warranty expense and you credit estimate warranty liability. Then when they honor the warranty, that's 2012, it comes out of the liability, in this case, and it comes out of the parts inventory. Now, does that take care of it?
I had all that. My question was, wouldn't you expense the warranty expense at the time of the sale, or would you wait till the end of the year?
Well,
Because it's at the end of the
now,
year
by the way,
instead of.
the effect of this, both will be the same, right? So, and you got a good question. When I did the example on the board, it was at the time of the sale. They do it as an end of year adjustment, because both the expense shows up on the same income statement as the revenue in both cases. Take your pick.
All right.
And of course, what they're saying here is that we take the total sales and multiply that times 4%,
Okay.
is how they do it. This took the
That's why they
specific
want to wait till
car.
the end of the year.
Yeah, this took the specific car. And again, it's, we're worried about, it's the matching principle, okay? So you estimate how much expense you'll incur with each sale. And both will work the same.
Well,
That was a good question. All right, when you're done there, let's go into another topic. All right, you guys doing good? All right. The people are still writing, so let me take a minute here. Guys, I'll set up the camera. Okay. Now, there's so much writing to do, and this just really works better when you have it in front of you. Julia, can I hand it to you? You done? All right. Can I hand it to you? All right.
Yeah.
And can I see who else was working with it? Anybody else? Okay. Yeah, when you're done, you done?
Yes.
All right. And Antonio, I'll bring it back to you. Anybody else want it? Okay, here you are. Let me go this way. I'll turn on the lights while I'm here. I'll drop this off on my way. Here you are. There you go. You're welcome. Now, let's get into contingent liability. Okay? Now, a contingent liability. Now, what we're talking about here is we're talking about the potential liability that can turn into a real liability given some event. So it's a potential liability that can turn into a real liability Okay, so it's a potential liability that can turn into a real liability given some event. Let me give you guys an example. When they build a dam or other things that's really dangerous, they can accurately estimate how many deaths will occur, and they know how much each death will cost, and they pay out the survivors and all that. So let me give you an example. Coal mines, fishing, all work the same way. I did a roots tour a few years back, and I went back to Locust Gap, Pennsylvania, where my mom was born. My grandfather was a coal miner, and he died close to 100. To the day he died, he had all these dark spots under his skin where he got caught in a cave-in. This coal was under his skin, they couldn't get all of it out. So anyway, he got caught in a cave-in, there was a long recuperative period, and then he went back to work the first day, came home from work, found my grandmother and the kids in a wagon. She said, "Jake, we're leaving. Are you coming with us?" They had it. So anyway, my grandfather, Jake, John, of course his name, they call him Jake, went in, and he went in the house, came back out and said, "Well, I see you took the kitchen sink. In those days, when you rented a house, you still had to supply your own kitchen sink. I guess I'll have to." So he got on the train, he got on the wagon went to the train, they went out to Denver where they had some relatives who they thought would kind of show them the ropes. The point of the matter is, there's occupations that are really dangerous, and they have to anticipate the costs. And they can accurately estimate how many people will die in a coal mine in a year, and they know how much each death is going to cost them. That's an example of it. Now, so here's how a contingent liability works. Okay, so here we have contingent liability. Okay, so it can be probable, it can be possible, or it can be remote. Okay, it can be estimatable, or it can be non-estimatable. And non-estimatable means we have no idea what it's going to cost us. Here we say we can very likely figure out what it's worth. So non-estimatable. Okay. So if it's probable and estimatable, okay, then you record it as a liability. Okay? If it's a contingent, if it's probable but non-estimatable, then you disclose in a note. If it's possible, then you disclose in a note. If it's remote, no disclosure. So it has to be probable and estimatable to be a contingent liability. Now, we'll go ahead and work with this scheme of things. In reality, you won't see many contingent liabilities on balance sheets. They're a liability, you know, just because your legal department won't let you put that in print. So they'll tell you, I don't care what you call it, don't put that damn thing in your balance sheet. And so you got to do something with it, but you'll rarely see it, just because your legal department doesn't want you doing it. Okay? So, again, here's a contingent liability. If an event could be probable, possible, or remote. If it's probable and estimatable, then you record it as a liability. If it's probable but you have no idea what it's going to cost you, you disclose in a note. If it's merely possible, a note. If it's improbable, you know, like remote, there's no point in disclosing it at all. Okay? So let's take a look at some examples here. Junior, I'm going to reach past you here. All right, thank you. Let me go back here. And let's take a look at it. So let's do quick study 11.4. So here's how quick study 11.4 reads. Okay, here's how it reads. The following legal claims exist for the Kalamazoo Company. Okay? Identify the accounting treatment for each claim as either a liability that is recorded, an item in the notes, okay? So the first one, Kalamazoo defendant estimates that a pending lawsuit could cost damages of $1 million. It is reasonably possible that the plaintiff will win the case. Okay? How would that be handled?
There's a note.
Record liability.
Well, let's take a look here.
It says reasonably possible, isn't it? Your second option?
All right, here's what your author says. Okay? B, and B is described in the note. So what they say is the reason is reasonably estimated but not probable. Reasonably possible is not probable. And so that's why they disclosed it in the notes. Okay? It's in that, you see there's 3 up there, it's in the middle one. Gene, are you doing good on this?
I'm totally confused.
All right, here we go, let me show you. So in this case, and Michael, I'll be right with you. All right. So here's the deal. In this case, make sure I don't hit Ted in the eye. All right, so in this case, it's possible.
Is this for the first one?
Yeah,
Okay.
possible,
Oh, okay.
okay. Now the next one is, they face a probable loss of a pending lawsuit, but the amount is not reasonably estimated.
No.
It'll be B again, okay? Because it's probable, but can't be reasonably estimated, so it's B. Does that make sense? And the next one, Kalamazoo estimates damages in a case to be $2,500,000 with a high probability of losing the case. A. And good luck getting this past your legal. All right? Okay, let's do exercise 11.3, page 464. So it's exercise 11.3, page 464. Okay? Here it is. Okay. So what it says, prepare any reasonable, I'm sorry, is this exercise 11.3? Oh, I'm sorry, exercise 11.3, page 464. Okay, here it is. Prepare any necessary adjusting entries at December 1st for the Moore Company year-end financial statements for each of the following separate transactions and events. A disgruntled employee is suing Moore Company. Legal advisors believe the company will probably need to pay damages, but the amount cannot be estimated. What would you do in that case?
Splitting it up.
The notes. Okay.
So what would be the adjusted injury?
Okay, in this case, no adjusting entry can be made since the loss cannot be reasonably estimated. Okay, the disclosure of the suit as a contingent liability should be made in the notes. Okay. And it's probable but not estimatable. I'm sorry, Sean, was that a question?
No, I was talking to myself.
Oh, okay, all
I
right.
do that from time to time.
Okay. The Moore Company guarantees a $5,000 debt of supplier. The supplier will probably not default on the debt.
No disclosure.
Yeah, can you imagine? We think this guy's gonna be good for his money? Yeah, anyway. All right, does that sound good? So. Okay, we only have one more topic, and then we can do a review. We're gonna get two more topics. Okay, you guys doing good? Yeah.
The one just prior to this, quick study 11-4,
Yeah.
you know, it was, B, B, A were the answers, but where were those numbers taken, or the letters taken from?
They were above it. It said, yeah, take a look right above it. And it says there's 4 options. And I think option A says it's contingent liability, and option B says it's a note. And it's right above it.
Oh.
A and B.
Yeah, A and B.
The last one.
Yeah.
Oh, this one, no adjustment.
Right. So the second one is
On the second one, the deal is it's not a liability. All it says is they're probably going to pay it, right?
yeah.
Well, there's no liability involved, they're probably going to pay it.
Right.
Oh, yeah.
It's, well, I think it's more like it's remote.
I have no idea. what
Because
all-
it's remote, there's no disclosure.
Probably.
What does it mean by remote?
Very unlikely.
Okay.
All right, the ratio in this chapter is times interest earned. Now, suppose you're going to lend somebody some money. How would you estimate the likelihood you're going to get paid back? Or a better way of wording it, what's the likelihood that these people can handle the debt? Okay? So times interest earned. It equals income before interest and income taxes divided by interest expense. Okay, so what this says is here we have revenue minus expense, and then we'll add back the interest expense, we'll add back the income tax expense, we assume it's a corporation. Then, this is what it is. So what it is, will the additional interest be manageable, is what it's asking. So you take the interest expense, you add it back to the net income. The taxes are after the interest expense. The taxes will change because the net income will change. Then you divide that. See you next week, okay? Then you divide that by the interest expense. What that says is, with this revenue, with this net income, can they manage this additional interest expense? Does that make sense? Sound good? All right. And you're okay with that?
Yes, because you have to provide your financial sheet to the bank in order to get a loan for
Right.
new business or something like that.
Right, you are. Right, you are. But what it is let's take a look at this. So what it says is that revenue minus expense. One of the expenses will be interest, and one of the expenses will be taxes. So if you take the net income, and that's before interest and before taxes, again, it just says, will this net income manage this additional expense? Does that make sense?
Not at all, I'm sorry.
Not at all. All right, how can I word that? So here's the deal. See if this is helpful. If income before interest and taxes varies greatly from year to year, okay, all it says, what it says is, if you're going to lend somebody some money, and you're gonna charge them interest, can they handle the additional interest expense?
Okay.
Is all it says. And so what it does is it takes their net income, and the taxes you don't want to consider at this point, because when you have additional expense, you have less net income and you have less taxes. So we're just not going to consider them. And of course, it's a corporation, so they have we're talking about corporate tax, okay? And then, what we're going to do is we're not going to consider interest expense. Then we're going to take the net income and divide that by the total interest expense, which would be the current plus the new, and see if that net income will cover the total interest expense. Does that make sense?
Maybe we put numbers to it.
All right, well, listen, here's the deal. Suppose they got $1,000 revenue, and suppose they have $100 in interest, in expenses. Suppose currently they have $10 of interest expense. So here's the revenue, here's the expenses, and of those expenses, $10 will be interest, and let's make it $20 interest and $10 taxes. So what you do is, this expenses, it will lessen by 20 when you take out the interest, it will lessen by 10 when you take out the corporate tax. So now, this will increase to 130. So now if you have 1,000 revenue minus $130, everybody see that? That will be what, 870? Divide that by the total interest. So currently it's 20. If I lend them the money, it will increase by 10, it'll go up to 30, okay? So divide this by 30, and will this net income be able to cover those expenses? Does that make sense? No. Gene, don't be a problem.
29.
That makes no sense.
So
It makes no,
if the
hey,
answer
put
is
numbers
20,
to it.
if the answer is 29,
Yeah,
and we need it to be 30,
you have some cutoff. You do have a cutoff.
okay.
So all it says is that here's the net income when you don't consider interest and don't consider taxes.
Mhm.
And when we lend them the additional money, it will increase the total interest expense from 20 up to plus 10 is for 30. So when you divide the net income by the total interest expense, will they be able to manage it?
Mhm.
And you do have some cutoff, okay? Is there a hand up?
Well, I was getting confused, but then when I actually just said it in my head, it made more sense because we have 870 divided by 30, which is 29.
Mhm.
The ratio is called times interest earned, so basically it's saying they earn 29 times their interest expense.
Perfect.
So if that's good enough for you, then you're like, all right, great. But if you say, no, they need to earn at least 30 times what they're gonna owe, then you're like,
And again, the reason you want to set the 30 is all that is because businesses go up and down. So currently, it's 29 times. But
it could be
what
less
happens
next
if
year.
there's a dip in business? So you say, just as a cush, we won't lend money to anybody that is less than 40. Because right now, they're sitting pretty. But who knows in a year? So it's got to be 40 to allow some cushion there. That's the sort of reason that we're going to. Gene, how you doing?
Okay, does that 130 have anything to do with that? It needs to be over 30, or is that just in the,
I'm sorry, what, this 30 here?
right there? No, the 130.
That's
Is that
what
a
you-
part of
that's
that
what you-
equation? 'Cause it looks like it's
Sure,
part of the equation.
here's what you do. This is the income statement, right?
Yeah.
Then what you do is what you want to do is you want the income statement before interest expense and before tax expense. So you add them both back in. So when you add the interest of 20 and the tax of 10, then this increases to 130. I'm sorry, it decreases to 70, doesn't it?
No?
No, this is the expenses before interest. So what you do, that's right. Okay, what you do is you take it out. Okay, here's the expenses that includes the interest and includes the taxes. So this actually, these expenses go down to 70. That makes this 930. Is that what you're having trouble with?
I just don't get it.
All right, okay, here's the deal. So this is the net income right now, right? Or the income statement, right? And so you have $900 in net income. And what you're saying is, can they handle the total interest expense that will occur if I lend them money? So what you do is you take the total income, now there's $100 for the expenses, you take out the 20 that's currently in there, you take out the 10 for the tax, so this lowers the expenses to 70. That means the net income is 930 with no interest and no taxes. Then you divide that by the total tax burden, because when I lend the money, the total income tax, the total interest will increase from 20 to 30. So the total interest expense in this time period will be 30. So it's times, so this will give you times interest. So
930 divided by 30?
whatever that turns out to be.
Then why is there a divide by 70? Or is that
Oh,
just
that's a
separate?
subtraction,
Okay.
that's a subtraction. So 1,000 minus 70 is 930. This is subtraction, this is division. Does that make sense? Well, okay.
I thought it was
There's
$130
$100
and I
worth of
had
expense
that.
here, right?
Right,
Then, when you add back the interest
okay.
of 20, you add back the taxes of 10, that's 30, so it reduces it
To 70,
to 70.
okay.
No, you're just being kind, right?
I'm gonna go and read this.
Here's the deal, right now, again, what you want to do is you want to say, can they manage the additional interest expense? Okay? So what you do is you take the total interest expense compared to the income before interest and taxes.
Okay.
Yeah, Levi and then Michael.
All right, so basically the reason you're taking out the interest and the taxes is because those will change if you give them a loan. They will have more expenses. So wouldn't you need to add those back in?
No, all it says is that the income if I get the net, what this says, if I get the net income before interest and taxes, okay,
Okay.
will that be large enough to cover the total interest expense? And in this case, if I take them out, it reduces this from 100 to 70, so will a net income of $930 be large enough to cover an interest expense of 30?
Okay.
And the way you compare numbers, you do it in two ways. You either subtract to find the difference, or you divide to find the ratio. In this case, you divide to find the ratio. And Michael was next, I'm sorry, Diana, Michael?
I guess the confusion that I'm seeing is, I mean, this is like a debt-to-income ratio equation. And so if you had $1,000 was the actual loan amount, you're saying that that expense of $100 is what's kind of skewing it, whereas, because you're gonna end up with 870, if you take the 1,000 and just say, okay, minus 30, you're,
Well, the 1,000 is revenue, right?
but, okay, the way the equation reads, it's times interest earned is income before interest expense and income tax, divided by interest expense. So it just seems like that $100 expense is kind of,
Well, this is $100, which includes interest and includes taxes. Right? So if you want it before interest and taxes, you subtract it back out. So the total expense was $70 before I included the interest expense and the income tax expense.
so then on your paperwork, then it should actually be minus 100 plus 20 plus 30.
That would
to get
do
your
it.
70, or plus 100, because you've got negative, on the expense, negative on the interest.
Well, I just meant you subtract it from here, is where the negative comes in.
I think that's where the confusion is coming in.
And so then I just meant you take this from that, take this from that, and end it with that, is where the negative comes in. Diana, thank you for waiting.
So what happens when the answer is bigger than 30?
Oh, you have to have some cutoff. And you say, listen, I won't lend money to anybody who doesn't have, this is EBITDA, it's the name for this. Okay, who doesn't have a times interest earned less than 40, for example. So what this says is, what you're saying is, will a net income of $930 be big enough to cover a total interest expense of 30? And if it is, I'll lend them the money.
So if the answer to that ratio is bigger than 30, then you don't lend them money?
Yeah,
Smaller.
Smaller.
So this goes into that, and if this goes in a lot of times, that's good. A few times, bad.
Okay, so if the answer is bigger than 30, then what?
Well, all it says is you have some cutoff, right? And what it says is, I won't lend money to anybody who doesn't have a times interest earned of less than 40. Okay? Because the interest, there has 40 times the interest to come to the net income. Okay? And the reason I'm doing that is right now, this looks pretty good, right? But because they can't have a interest down, because they can have a business downturn, I want some cushion there. And all it is a way to evaluate whether this company can handle the additional interest expense. Is all it says. Is if I lend them the money, do they have the net income to cover that additional interest expense?
So if it's less than 40, then you don't lend them?
Exactly. And that would be it. And again, maybe this would be helpful. You know when you do these ratios and all that, there's two ways you can compare numbers. You can either subtract to find the difference, like what you do with working capital, or you can divide to find the ratio. And that way it gives you some sort of an index. And all this does is it finds an index. And that's, the ratio is like an index. Antonio, how you doing back there? I see, all right, you doing good? All right, okay, all right, good, good, good. Everybody else doing good? All right, sounds good. Tim, you doing good over there?
Yeah, is that rate set by underwriters or who sets it?
It's just a way for you, it's just an index. As far as the rate goes, what you could do is, the way it is Dun and Bradstreet are editors. And they produce industry standards.
Or they can just give you money at a higher interest rate.
Yeah, if you had a bad one, you'd have to charge more. Yeah, that's because it's riskier. Yeah, that's true. And what they do is they have a whole bunch of industries, you know, and they will show you what the times interest earned is for the top performers, middle half, lower performers. That would be one index. It would also be a measure of risk. That's also true. And it can also have a cutoff, go or no go. And it's an index to just judge it.
And would it be, I guess, the responsibility of a CEO or a CFO or?
Yep, some finance type of person as to says this is what we'll live with. Yep, somebody in finance. Okay. All right. And then don't forget, with corporate income taxes, we got one more minor topic here. Okay, Gina, I'm going to move this just a little bit on tape. It'll be interesting to see what this one looks like. All right. So listen, here you have net income. Okay. Times the tax rate. What that does is that gives you the income tax expense.